Welcome to another edition of the interview on RadioNow 95.3 FM Lagos. Today, our focus is on the ABC of stock trading. Joining me for that conversation is Mr. Fakrogha Charles, who is a chartered stockbroker, a broadcaster, and a training. And he has had years of experience in the stock exchange market. Welcome to the program. It's nice.
Thank you for having me again. It's nice to be here.
How are you doing today?
Fine.
All right. So what is stock trading and how does it work? Let's start from there.
Okay. When you say stock trading, we need to understand what is stock. Then what is trading? Of course, trading will mean buying and selling. You are trading, and you could trade any instrument, any commodity. It's trading. You can buy and sell rice. You can buy and sell cocoa. You can buy and sell stock now, which is securities. Okay, let me use that word now. So when you are saying stock trading, you are buying and selling securities of quoted companies. Companies that are listed on an organized exchange where people can come and buy and sell that security. It is regulated. And there are different types of securities.
So why is stock trading an attractive investment option for many people?
Yes, stock trading is very, very important. But like you have asked, why is it important? Now, for companies that are coming to raise funds from the market, there is a market, they sell their securities, they sell their stock to members of the public. People subscribe, people buy. And now when you do that, you are buying a portion of that particular company. So you own a part of that company. Now, you own a part of it. A time will now come, you don't want to own that part again. You want to sell it off and get your cash back. You now go and sell. And that is being provided by the stock exchange. Which is... that provides a financial infrastructure, that kind of exchange for buying and selling to take place. So people now buy and sell. That's why you have made mention of stock trading. Now, why are people trading stocks? Because, one, they want to make profits. Like any other commodity, you buy at a certain price, you see the price go up, you sell to make profits. Now, you can also make a loss because if the price goes down in the market. Now, people buy this stock not only just to trade, some also buy it to keep. Like any other assets, you buy to keep. We call those are the real investors. But as you are keeping that asset, they want to be sure that the asset is giving them some returns. And that is why, as they buy, they don't sell, they don't trade it, but the assets give them a return. That is, the company which they have bought those securities, if they make profits, of course, they will pay the owners of the company. So those are some of the issues involved here in stock trading and stock investment.
Thank you very much. I'd like to ask, what are the benefits and risk of stock trading, and how can investors manage this risk?
Okay, let's start with the good news, the benefits. What are the benefits of buying stocks? There are a lot of benefits. One, you could use it as a wealth creation tool. Two, you can use it as a form of savings. Instead of saving your money in the bank, you invest in stock. You invest in securities. Then, if you have bought a very good company, that means you are a part owner of that company. Another benefit is prestige. People want to talk about it in the social gathering. Oh, I'm a shareholder of MTN. I'm a shareholder of GTCO. I'm a shareholder of Dangote Cement. Okay? All the workers in Dangote Cement are working for me. People use it as a status symbol. Those are some of the benefits. Now, there are a lot of risks involved in it, like any other venture. The risks involved is you could buy a share, or a security, as the case may be, in a company, and the managers of those companies don't manage it very well. They are not making profit, they go under. So you as a part owner, you have also lost your money. As compared to another category of stock, another asset now, which is, we say bond. In that case, it's also a security, but instead of you being an owner, you are a creditor to that company. So a Dangote can come and say, okay, we want to raise money. You give what they call an IOU, they take from you. That is their bond. Now they will tell you how much they are going to pay you, maybe in 6 months, in 1 year. That is a fixed security, a fixed income. Now, whether they do well or they don't do well, because it is credit you have given to them, they must pay you back your money. So if they are going to liquidate the company, of course, they pay back those persons, those stakeholders who are creditors to the company. They get paid first. And maybe at the end of the day, there will be nothing left to pay the original owners, which is the shareholder. So, yes, that is a risk. There is also a risk of you not getting any dividend. The company is still operating, but the managers will tell you, for the interest of the company to be sustainable, these monies we have made, we want to use it to plow back to the company, to do other, so that in future, in the long run, it's beneficial to everybody. But me and you know that in the long run, we are all dead.
All right, let's look at getting started now. How can beginners get started with stock trading, and what are the essential steps to follow?
Well, the first thing I would say is let beginners understand how to get involved, how to buy the stock first before they start trading it. Because you need to understand the mechanism, the dynamics of stock itself, then trading it. Now, for any beginner to go into stock for the first time, I will ask that the beginner should be open-minded and you should have some basic information. You should do your own little research. The first place of call, a port of call, I would have said, you get in touch with a stockbroker. It's very important. But before you see a stockbroker, do your own little research. How do people own stocks? You own stocks simply by buying the shares of the company. And there are so many ways you can buy these shares. One, the company is selling. Like we saw recently, some of the banks in the country. We had the likes of GTCO, the likes of Access, the likes of Fidelity Bank, when their regulator said you need to increase your share capital, and they needed to go to the public to raise this money. So they were selling their shares. An investor can take that opportunity and buy. That is one way of you becoming a shareholder. Now, once you have bought, you are now a shareholder. Your name will be in their record, because they also have their registrars that keep records of the shareholders, their addresses, their name, it is there. So that by the time the company makes profits, they will pay to those persons that they have their names on the register. Now, you have done that. You need the assistance of a stockbroker. It's always advisable. You cannot get involved in stock trading without getting a stockbroker to be with you. You must have your stockbroker. Just like you have your pastor, you have your doctor, you should also have your stockbroker who will guide you through. Now, coming to stock trading now, you can now tell your stockbroker you want to start trading stocks. Again, the question is going to ask you, can you afford the risks? Because when you buy and sell, it's not all the time you are going to make profit. The advice is, once you buy a particular security and you've seen the price going down, the advice will tell you, don't be scared. It's a normal market practice for prices in the market to go up, and come down. But your purchase of any particular securities will be, how is that company performing? What is their past history? Are they paying dividends? Who are the people behind this company? Who are the managers? What products Are they producing or service? Is it selling the market? Who are those behind it? Because if I see a convicted criminal, in the board of a company, of course, that is also a red flag. But you know that the company is doing well in terms of their product in the market, and you have seen their past records in terms of profitability, then of course, you can now buy those kind of securities. And that is where you need to do your own little homework. Understand what the company is doing. And say, okay, the company is into, let's say, telecoms now. Everybody knows that. And you yourself, you use telecom services on a daily basis. So you know that these companies are making money. So why not partake that money they're also making by becoming their shareholder? And they're there in the market. The telecom sector is there. It's not my place now to advise you whether to buy this or buy that.
Yes.
You even go to the agricultural sector. You see companies there. There is Okomo Oil, there is Presco, there is Ella Lakes, FTN Cocoa, so many of them there. Your duty is to look at the history of this company. Study them very well. Look, in fact, if you can even visit the companies and see what they are actually doing, that will now enable you to take informed decision as to whether to invest in them or not.
All right, looking at investment now, I'd like to ask, what are some common mistakes that new traders make, and how can they be avoided?
Yes, the mistake most traders make, that is new ones, I would say, or amateur ones for
new traders, yes.
One, they don't do their proper study very well. You need to do your homework, your research. You need to do it very well. And you must ask yourself, what is your objective? What are you trying to achieve? Because you cannot say, okay, you want to do ethical investment. You want to trade ethical stocks. And you are going to buy a company that is using child labor. That means you're also supporting those companies. Your 1 naira goes a long way in assisting that company. So investors should look at their own personal values, look at the objective before they invest in the company. But we see so many of them, they make so much mistake when it comes to selecting their stock. But in the markets, all the sectors are good to invest, but it now depends on the investment objective of that particular investor. Another mistake they can make again is always looking at short term. Yes, short term investors. You buy a stock today, maybe by 2 days,
you want to sell again.
The price is going down, you are afraid you want to sell. And that is where one of the very, very well-known investor today in the world, Warren Buffett, is saying if you cannot hold a stock for 10 seconds, for 10 years, they don't invest in the stock market. What he's trying to emphasize is long-term investment. And if, as an investor, a new one for that matter, you understand these little things, understand the company fundamentals, understand what the company is doing, understand your own investment objective, then you are likely to reduce these mistakes you are making. Then again, you must also have the ability to be risk tolerant. You ask yourself, can you afford the risks? I always advise, for a new investor, please do not use funds, money that you want to use maybe to pay your school fees, pay your house rent, and do some other things to bring to the stock market. I wouldn't advise that because the returns are not guaranteed. But we've seen so many of them. They go and bring money they want to use for house rent, school fees, and bring to the stock market. And when the market goes against you, then you are losing money. Then you will now come and begin to shout that this is a scam and all that. So investors should do a little homework, talk to their stockbroker, and of course, they will advise them properly as to how to go about their investment in the stock markets.
All right, how do stock prices work, and what factors influence their movement?
Yes, just like any other market, demand and supply. It's number one factor that affects the price of the market. Yes, stockbrokers, traders will say effective pricing, valuation. There are so many things that affect the price of a stock. So many. One, the performance of that stock. If a company is doing so well and they say they have declared billions of naira in terms of profits, then of course, everybody wants to go and buy that company. What happens? The price will go up. That's it. Then government policy. I'll give you a recent example. The government said, insurance companies, please go and recapitalize.
Recapitalize, yes.
And what happened? Because people believe that by the time they recapitalize, they'll be able to do more business, it become profitable. People started rushing to buy insurance stock. So government policy can influence the price of stock. Even macroeconomic conditions. Inflation rate has come down. It also impacts on prices of stocks in the market. So then, of course, ESA. If there are ESAs in the market, you just hear that, oh, a particular company is going to be acquired by another company, or a company that is not doing well. You now said, oh, they have a foreign technical partner now. They're coming to acquire them. Then, of course, people are saying, okay, if that technical partner comes, that means this company is going to be viable again. So they will want to come and buy. So ESA can also affect prices of equities or securities, as the case may be, in the market.
So what are some key stock market indicators, and how can investors use them to make informed decisions? I know you just talked about some being acquired and all that.
Yes. Well, that's what professionals call fundamental analysis and technical analysis. Let me even start briefly with the technical analysis. I won't go into details, because for new investors, it might not make meaning to them. That's why I say you need the guidance of a stockbroker to guide you through. Now, for technical analysis, market indicators that would guide investors in terms of their decision making, you look at the volume, the price the company has done for quite some time, and you can now come up with what they call relative strength index, RSI. That will now tell you whether the company you need to buy, or is oversold or overbought. You need to come in now at this appropriate price to get in or to exit your stock. You can also use what they call moving average convergence. These are just technical indicators, and of course, it's only your stockbroker that can explain how to interpret some of those information to be used. Now, coming to fundamental analysis, anybody can do it. You look at, is this company, what is their earning for last year? What is their earning for this year? You compare. So if there's an increase, okay, it's going to be a good company, you can invest in there. So those are some of the indicators the novice investor can use. But in all, I always advise, get in touch with your stock broker.
So what are some common risks associated with stock trading, and how can investors manage this risk?
There's a lot of risks involved in stock trading. We mentioned them before. The risks, there could be market risks. There could be liquidity risks. There could be systemic risks. There could be reputational risks. You know, when we say reputational risks, you buy a company, and of course, maybe a management staff of that company, or a board of directors, or the MD is involved in criminal activity. That's reputational risks. It will affect
the company.
And of course, investors who have invested in that company will also lose out. So that is also a risk. Then you can also have market risks, where the whole market is affected. That is, you look at the money market and the capital markets. Now, when government is doing their own treasury bills, they increase their rates, then those in the capital market will want to sell off and move to the fixed income. So you can have market risks. It's affecting the whole market. You can even have what we call industry risk. Look at what happened in the banking sector, or those companies that have something to do with FX. Because of the devaluation of or floating of the naira, we saw how most of these companies were declaring FX loss. Thank God they are now coming back and we are seeing some stability. So there are different types of risks in the market. But for any investor, before you go into that investment, you must know, high risks, high return. There is risks in the market. But it's your ability to recognize the risks and put measures in place to mitigate some of those risks.
Yes.
You cannot completely rule out risks in investment in the market, just like life. Life itself is a risk.
All right, taking that risk now, what are some strategies for managing emotions and avoiding impulsive decisions in stock trading?
Yes, stock trading is a technical business, and at the same time, we are emotional being, and when you are investing, it is difficult to remove your emotions. But we have advised investors the way you can take off emotions. One, you have to be self-disciplined. Then you need to also, because the major emotions in the market is greed and fear. If you are able to take care of greed and fear, you can manage your emotions when it comes to stock trading. One good strategy you can use is what we call Naira cost averaging. You just agree that at the end of every month, I want to be investing 10% of my earnings. So if you earn ₦1 million, 100,000 naira every month. So whether the market is up, the market is down, you are investing your 100,000 naira every month. That would have removed emotions from it. But if you don't have that kind of strategy, then you invest in a particular company and the price is going down. Because you're afraid, you sell off. And maybe really you sell off, the price start going up. So to remove that emotion of fear, you come up with that strategy of Naira cost averaging. Now for greed, again, for greed, you buy a stock 10 naira, the next day it's moving up, up, and you are refusing to sell. That's emotions, because you are believing that it's still going to go up.
Yeah.
And before you know what, it start coming down, and you start regretting. Now, how do you take care of that? To take care of your greed in the market, you have what we call an exit point. You will say, as I am entering this particular security, 10, 20, 50, 100%, as the case may be. Maybe it's 50%, 30%. As soon as you buy it at 10 naira, it has done 10% increase. Then do you do what? You exit. You have removed greed. So these are some of the mechanisms a stockbroker will advise you when you are investing in stock to take care of greed, or you take care of your emotions while you are investing in the market. But note, emotions play a major role in investing in the stock market. Whether we agree or not, emotions play a very big, vital role in stock investment.
All right, talking about investing versus trading now, how can investors determine whether they are better suited to investing or trading, and what are the key considerations for each of this approach?
Yes, I'm happy you have mentioned the distinction now between trading and investing. So we have investors, we also have speculators. The speculators are the traders, let me just put it that way now. Now, the investors, they want to invest and keep. They are buying a particular security, they want to keep buying, and as long as they don't have any need for cash, they just keep buying, and they are waiting for the company to do well and pay them dividends. That is the investor. However, that does not mean that if there is a need for them to raise cash, they cannot sell what they have. They can sell. But for the traders, the speculators, they are there, they are not interested in the company. What they are interested in is to buy and sell and make their profits. So there are some we even call day traders. They buy in the morning today, that same today, trading day, they are selling because they have met their margin. We also call them speculative traders or speculators. But again, For you to get into speculative trading, can you afford the risks? And that is why you need a different set of mindsets, different set of training for you to be involved in speculation. Because you could profit very well from it, at the same time, you can also lose so much from that buying and selling. So how can investors know whether they can go into speculation or going into investing? My advice will be talk to your stockbroker. They will be in a better position to assess your risk appetite to know whether you can go into speculation. Or investing.
That's quite a tough one.
Yes.
So what are some benefits and the drawbacks of each approach, and how can investors make informed decisions?
Okay, for the investors, yes, the benefits there is you are agreeing with the company, you are looking at what the company is doing, they make profits, you are there to, and good thing, we have some of these companies that even pay dividends to their shareholders twice a year. Interim and final. So you can use that to arrange your cash flow. There are also some other investments, like the fixed income, where they pay you dividend, pay you your coupon on a quarterly basis. So you can use that to determine your cash flow. Now, you know that at every 3 months or 6 months, you have money coming into you. Fine. Now, for the other aspect of it, the speculation, then the risk is there. And you don't need to come and use small money for that kind of investment for you to take advantage of that benefit. You need to invest a lot of money. And are you also willing and ready to lose that kind of money? So again, it boils down to your own risk appetite. And we have some tools that stockbrokers can ask you certain questions and be able to determine your risk level. And once they determine that risk level, that is when they can advise you that you cannot go into this investment. Instead, you can go into investing. You can go into becoming an investor where you just buy on a regular basis and you wait for the company to pay you their dividends when they declare profits.
So what are some common mistakes that investors make when learning about stock trading, and how can they be avoided?
You learn on a daily basis. And like I said earlier, you should have an open mind. You know, there are a lot of mistakes. One, rushing, not taking time. Looking at researching on a particular company they are investing in. That's one. Then two, not understanding the market dynamics very well before taking decision. Again, there are a lot of, everything has been made so simple that your stockbroker can even give you what we call online access, where you can trade. He will just monitor and see what you are putting in and all that. But you should do a lot of education when it comes to stock investment. And there are a lot of stockbroking firms who do that. There are a lot of online materials, applications you can even look at to tell you the fundamentals of, or the basis of stock investment. Get knowledge first. Learning and continuous learning will go a long way in assisting the investor in taking informed decisions.
All right, as we begin to round off now, how can investors stay motivated and focused on their long-term goals? And then what are some strategies for overcoming obstacles and setbacks?
Okay. Your long-term goals, you have to set your goals yourself. I always advise, let your goals be smart. By smart, I mean the S is specific, the M is measurable, the A is attainable, the R is realistic, then the T is time-bound. Once you set that SMART goal for yourself, maybe in the next 5 years, you want to grow your portfolio. To be a particular amount, then you will now come back and say, okay, in present day, how much should I be doing so that in 5 years' time, this is where I want my portfolio to be. The first strategy I've mentioned is Naira cost averaging. Set aside specific time frame. It could be monthly, it could be quarterly, as the case may be, and you discipline yourself. In fact, you can even tell your bankers that every quarter or every month, before your salary even comes to you or your profit or whatever, ensure that this amount of money is debited and credited to my investment account so that I'll be buying these shares on a regular basis. Now, the only challenge, obstacle you can have there is maybe when you stop working or you are no longer working or your business you are doing has gone under, you're not getting any profit. That is when you don't have the money for that investment. But if you say you want to be doing it on your own, challenges will come. There are competing demands. Things will come that you say, okay, I cannot invest this month again. I'll invest next month. Another next month will come. There is another demand for issues. Like they say in economics, they say our wants are insatiable, but the resources to meet those our wants are limited. Anyway, I don't agree with them. So we will need to be disciplined, apply the Naira cost averaging for us to navigate the uncertainty in the investment space.
All right, then, Mr. Fakrogha, I'd like to thank you very much for your time and expertise on this conversation. We really appreciate you.
Thank you for having me. It's always a pleasure.
We've been speaking with Mr. Fakrogha Charles, who is a chartered stockbroker, broadcaster, and trainer. And we'll be looking at the ABC of stock trading. That's a package for today. Till we'll come your way again when we bring you another edition of the interview. My name is Abiodun Adelore.